Hi, I'm Steve Van Metre. Welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of a market. It might be making sense now. But anyways, I want to thank you for taking 15 minutes out of your evening to be with us tonight. I certainly know it'll be worth your time. All right, so why is the markets all of a sudden, stocks are in rally mode? Now, we're not seeing bonds follow this, but what's all of a sudden this euphoria that's back? And that's simple. Everybody thinks the Fed is going to ease and eventually bow down to President Trump. Some people are even suggesting that President Trump is by far more brilliant than most people are giving him credit for, because he has figured out the way to make the Fed break. Simple. Go out and do a bunch of tariffs and slow the economy down, force the Fed to ease, and then magically run around and clean everything up after the Fed has eased. And then, of course, the stock market will go up and he wins the re-election in 2020. That is the narrative. Now, I'm not telling you that it's correct. I'm not telling you it's not correct. I'm just telling you this is what the market thinks right now, and the market's not very bright. So you always have to understand that most people that are invested have no clue of how the system actually works. They just go on these notions that you see on Twitter and on forums. People say, well, if this trade war with Mexico ended, stocks, S&P would hit 3,000. The question you should always ask is, why? Are there people sitting on the sidelines with so much money that this Mexico tariff thing matters? I don't think so. That's not exactly how it works. One of the problems we will see, even if the Fed does ease in their upcoming meetings, and I don't think they'll ease in their June meeting, although there's a lot of expectations for them to lower the federal funds rate by 0.75%. I just don't think that's going to happen, because the Fed has to be aware too that they're being played, and the Fed has to maintain a position of being apolitical. So they really don't want to be drug into this, and they know they're being drug into it. So my guess is that they're going to hold tight. Of course, we'll see soon enough in their June meeting. I haven't looked up the dates of when that is. But anyways, that's the view, is everyone wants to get in because they think the Fed's going to ease, and then Trump's going to lower all these tariffs, make a bunch of cool trade deals, and boom, the economy is going to skyrocket. And now, and here's why. Because there is at least an 18-month lag in monetary policy. So even if the Fed dropped interest rates to zero today, wouldn't matter. We still have to chew through all those rate hikes, all the balance sheet unwind for at least 18 months. And it could be, the lag could be closer to 24 months. I have desperately tried to measure it. I can't. The best experts that I can find say it's 18 months, but honestly, it could be a couple months longer. We just don't know. The content of this video is provided as educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. Opinions expressed in this video that I'm do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. So you'd think I could read that or have it memorized by now, but I don't. Okay, let's go and check some slides. So I meant to take a look at the McClellan Summation Index that we've been looking at, and you can see when it breaks zero, which it has as of yesterday, this updates the following day, and you can simply go to stock charts, pull up the symbol $NASI, and change it to weekly, run it at 5 years, and I'm not sure what other settings I have, and you can get the same thing I've got. And what this says is, forget the market this market rally. This summation index is kind of a proxy for liquidity. It says, look, liquidity is drying up. Stock prices should be headed lower. So don't get too excited about this market rally at all. Going on from there, this was pretty interesting. This article was posted on Zero Hedge, and you can see global stocks are trending way above the global factory data, and that is highly unusual. Usually as the global economy falls, global stocks fall, and they're not. And at some point, either the global economy has to go higher or the stock market has to go lower. And you can even see that looking at the high yield spreads that are inverted. They're saying that yes, the S&P 500 is indeed headed lower, as we've looked at with interest rates, oil prices, and all kinds of other things. All right, so now in an ode to MC Hammer, ring the bell, school's in session. We're going to take a look at the Wycoff distribution schematic and see how it applies to the S&P 500. So let's take a look, and let me get my S&P 500 chart pulled up, which I probably should have, and here we go. Let's get this lined up. All right. Oops, I guess. So what I want to focus on right now is I think we are in this UTAD spot because we've looked at this before where this is just a very good picture except for that drop in December, which would have broken below these trend lines here according to Wycoff. But when Wycoff was live, they didn't have computer programs that were trading volatility either. So the UTAD is the upthrust after distribution. So this move here, which we'll look at in the S&P 500 chart, is when the big players are doing kind of their final distribution, then they let the market run back up, and then they sell down. So notice it goes up, comes down once, up, and then goes in between support and resistance, those two lines that they've got here. And then once this resolves, it starts to break down. So let's go take a look at the S&P 500. And here we have, oh shoot, there we go. Here is that distribution event from the big money. Here's the market coming back up. And look, we have one move down, hit support right here. This, you can barely see the dotted purple line. In fact, why don't we just delete that there. Here's the dotted purple line, hits support, and comes right back up to the prior level of support. And does that make sense? And the answer is, yep, there it is. Hit support, falls back kind of right up in where the prior all-time high was, and this got up to, I'm trying to flip this back so you can see it, there it is, came back up to roughly the January all-time high. Market comes down to the next level of support, and what does it do? It's rallying up roughly to right in here of resistance. So there you see one move down up, a second move down up, and let's see what Wycoff had to say about that. He said one move down and up, second move down and up. So this move we're seeing right now, if this pattern is correct, and it looks pretty good so far, that the rally here should come to an end pretty soon, and there should be a move down, and that move down should continue until we get into this what's called SO. And let's see, sign of weakness, observable as a down move or slightly past the lower boundary, and that's what we should see next. So that's pretty interesting, I think, of what is going on, at least in terms of Wycoff and the S&P 500. Now, I also want to look at the dollar index because I think this is in a topping pattern. And I'm going to switch over and scroll down and see if we can find that chart. Got it. So here we are with the Wycoff distribution chart. And this one almost looks exactly like the dollar chart. I mean, if you look at it, we've got the move up here, higher high up here, and then down, and this kind of lazy kind of rally going up through here. Looks really good. Now, according to Wycoff, we should see this a final move of the dollar up here from 98 to somewhere between 98 and 100, somewhere up to these prior all-time highs. So let's take a look and see. Yeah, it should kind of get right up underneath the January, one of those two prior all-time highs, and we are, shoot. I'm alt-tabbing like crazy, and I keep getting the wrong screen. So we're really close. You can see, I mean, a move up to 99 at this point would be fairly well justified. And in terms of resistance, there's a lot of resistance right up here. You can see a lot of trading activity at 99. So it wouldn't surprise me if we see a move up to 99. That would be a big topping pattern. Now, one thing that Wycoff does not say, or at least I haven't found, is he hasn't said if you take this pattern and you measure it some way or another, it gives you an approximate idea of how much higher or lower things are going to go. At least maybe I need to buy his books because I'm just looking at what I can find online. It's possible there is some sort of measurement there, but there's a general rule. The longer things are in a topping pattern or a bottoming pattern, the bigger the following move is, either down if it's a topping pattern or up if it's a bottoming pattern. All right, so let's take a look at another thing that I noticed is 7 to 10 year Treasury bonds. And let's see if we can find a Wycoff pattern in here. Now, Wycoff patterns are going to start after a move down. So this would be a topping move. This would be a down move. So what we want to see is a buying pattern. So I'm going to go see if we can find that. All right, let's take a look at this one. Here we go. All right, so here is the accumulation schematic number 1. So you have a sell down, a bounce up, a higher high, a lower low, a lower low, and then slow build into here, a consolidation range right near one of the prior all-time highs, and then it takes off. Okay, let's see what we've got. And when you see it, you can't unsee it. So here's the move down. You get a double bottom, and what we're looking for is a high followed by a higher high. Boom, high, higher high. Another move down, which is consistent to a lower low. Now this is a little bit elongated in terms of his chart, but it is moved, eventually does move down to lower low. It moves up, consolidates, that matches. It makes another move thrust higher, and then it consolidates right near the prior all-time high right here. And once this consolidation move is over, boom, you're off to the races. And if we push this back, you can see it. Here's the first move up, second move higher high, and then you've got, let's see, that move lower, and it makes a move. It didn't really, this is the move it didn't fully do, but it did make this move down here, and it is making this move here. Now, of course, somewhere Wycoff would probably say, look, these aren't exact patterns, that these are just general views that I saw, and there may be some more, but these are the top 4 for sure. But you can see right here, we're trending right now in between this resistance area, and you can see it again right here. So here's the prior all-time high. Here we are trying to fight this battle out here. And what happens when this breaks out? Boom, prices go up. And you can see this big spike in volume, and it was fairly large right up in here. And let me zoom that in. You see there's a big spike of volume here, meaning people came in and sold this very heavily, but they were met by buyers. So remember, volume is a match, buy to sell. So if a lot of people are coming to sell, that means a lot of people came in and also bought, and prices didn't fall. So that means we're seeing consolidation here. Could bond prices slip back down to this level here, and then take off? Sure. But for the moment, this pattern is looking pretty close. I mean, it's not identical, but it's pretty darn close. And what that tells you, between these 3 of these things, something very important. Stocks are headed lower. Bond prices are headed higher, which would be consistent with how stock and bonds move. And we know that because stock prices should follow yields most of the time, and yields keep going down and stock prices aren't. It also tells you the dollar's got one last move higher, and then it goes down, which opens the door for any dollar-sensitive asset classes, mainly gold, which has been in a long bottoming pattern, and agricultural commodities also in a long bottoming pattern. So you really get some interesting dynamics here. And the reason we're talking about this is it's really important because I'm pretty excited about this. In Friday's update, you're going to read more about how the smart money is positioned and why, and I may even continue on that in the next week or two. I'm just not sure. I got a lot of things I want to write about. But there's one thing that as an investor you want to do, and that is get on the side of the smart money. And how do you do it? You have to study what they're doing. You have to study the charts and figure out where they're at. And this is pretty darn clear of exactly where they're at. And when you can shift to being in sync with the smart money, which is the opposite of pretty much what most investors do, even if you're late to the party, you can still ride their coattails up. Because at this point, let's say we are buying bonds today, let's just pretend that we just saw this chart for the very first time. Yeah, you can say, well, we didn't get the bottom. No, but the next big move, according to Wycoff, starts from here up. This is the big move. So you can be late to the party as long as you can identify the pattern. And that's what makes looking at charts interesting, because people spend every minute of their trading day, those who are professional traders, trying to decipher what the chart is telling them. Now, I don't like looking at minute charts or hourly charts or anything like that, but when you look at the bigger picture, you see these bigger picture moves. And now all of a sudden, if you're following this, what it tells you is you don't want to own stocks, you want to own bonds, and you want to be ready to buy gold, and you want to be buying agricultural commodities at some point as well, because that's the move that's coming. That is what is about to happen. And once you see that move switch, does it make sense now why every Monday when the data is available, we look at that website, Hedgeopia, of how the smart money and dumb money are positioned? Well, we look at the dumb money, but we know the smart money is exactly opposite position, because as long as we can move into sync with them, you're just riding the wave over and over and over. And if we look at this Wycoff chart, which is interesting that they're using this, because it's so old and outdated that most people don't even look at it, it tells you the smart money going deep in their playbook to fool everybody. And with that, we'll see you Friday. Bye now.